Stop what you're doing for a moment, because the story we're about to discuss today could affect every economy, every stock market, and every household on the planet. Right now, one narrow waterway in the Middle East, just 21 miles wide at its narrowest point, is threatening to send global oil prices soaring. And according to analysts at Goldman Sachs, if the disruption in this region continues, oil prices could surge above $100 per barrel very quickly. Now, that might sound like just another commodity headline, but it isn't, because this tiny stretch of water, the Strait of Hormuz, is one of the most important energy choke points on Earth. Every single day, roughly 20 million barrels of oil pass through it, representing nearly 20% of the world's oil supply. If that flow is disrupted, even briefly, the ripple effects can move across the entire global economy. Gasoline prices rise, inflation accelerates, stock markets become volatile, and geopolitical tensions escalate even further. In other words, what happens in the Strait of Hormuz doesn't stay in the Strait of Hormuz. It spreads everywhere. And that's exactly why global markets are suddenly paying very close attention. Welcome back to John Forecast, where we break down the macro forces shaping gold, oil, commodities, and global financial markets. Today, we are going to unpack a critical question. Could oil really surge above $100 again? And what would that mean for investors, inflation, and the global economy? To answer that, we need to understand three things. First, what's actually happening in the Strait of Hormuz right now? Second, why Goldman Sachs believes oil prices could spike dramatically. And third, how an oil shock could reshape global markets in the months ahead. Because history tells us something very important. When oil markets become unstable, the consequences can be enormous. The strait that controls global energy. Let's begin with the geography. The Strait of Hormuz sits between Iran and Oman, connecting the Persian Gulf with the Gulf of Oman and the open ocean. On a map, it doesn't look particularly impressive, but in reality, it is one of the most strategically important shipping routes on Earth. Every day, massive oil tankers leave ports in Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, Iran, and they all pass through this single narrow channel. According to energy analysts, around 1/5 of global oil consumption moves through this strait daily. That's nearly 20 million barrels of oil per day. To put that into perspective, if that flow stopped suddenly, global energy markets would lose an amount of oil roughly equal to the entire daily production of the United States. And that is exactly the risk analysts are now worried about. The current crisis. The latest tensions began after escalating military conflict in the Middle East triggered disruptions to shipping in the Strait of Hormuz. Tanker traffic has collapsed. Some shipping companies have halted operations entirely. Insurance costs for vessels entering the region have skyrocketed, and hundreds of ships have reportedly waited outside the strait rather than risk passing through. This disruption is already sending shockwaves through the energy market. Oil prices have surged rapidly, with some benchmarks jumping more than 20 to 30% in early trading during the latest escalation. And that's where Goldman Sachs enters the picture. Goldman Sachs issues a warning. Analysts at Goldman Sachs recently warned that if flows through the Strait of Hormuz do not recover soon, oil prices could quickly move above $100 per barrel. Why? Because the global oil market has very little spare capacity to absorb a sudden supply shock. Most major oil producers are already operating near production limits, and alternative shipping routes simply cannot handle the volume that normally passes through Hormuz. Goldman analysts estimate that only about 4 million barrels per day can be rerouted through existing pipelines, leaving roughly 16 million barrels per day potentially vulnerable in the event of a full disruption. That's an enormous amount of energy supply at risk, which means the market is now pricing in something economists call a risk premium. What is a war premium in oil? Let's pause for a moment and talk about something traders call the war premium. When geopolitical tensions threaten oil supply, markets begin pricing in the possibility that production or shipping could be disrupted, even if the disruption hasn't happened yet. The result? Oil prices rise before any actual shortage occurs. It is essentially the market's way of saying, we are not sure what's about to happen, but we know the risks are rising. That's exactly what we're seeing now. Let me ask you something. When was the last time oil prices surged this quickly because of geopolitical tensions? If you're thinking about Russia's invasion of Ukraine in 2022, you're exactly right. The conflict sent oil prices soaring above $120 per barrel, and it triggered one of the biggest global inflation spikes in decades. The situation today may not be identical, but the market dynamics are starting to look familiar. In a world obsessed with artificial intelligence, electric vehicles, and digital economies, it's easy to forget something. Oil still powers the global economy. It fuels airplanes, ships, trucks, factories, agriculture, petrochemicals, and even the plastics used in countless consumer products. Despite the rapid growth of renewable energy, oil remains responsible for roughly 1/3 of global energy consumption, which means when oil prices rise sharply, the impact spreads everywhere. Transportation costs rise, food prices increase, manufacturing becomes more expensive, and inflation starts creeping back into the economy. The inflation problem. This is where the oil story becomes particularly important for central banks. Over the past few years, the global economy has been struggling with inflation. Central banks raised interest rates aggressively to bring price pressures under control. But if oil prices surge again, those inflation pressures could return. Analysts warn that a sustained oil shock could add nearly 1 percentage point to global inflation. And that creates a serious dilemma for policymakers, because higher inflation means central banks might have to keep interest rates higher for longer, which slows economic growth and increases recession risk. Emerging markets. Under pressure, oil shocks also hit some countries much harder than others. Oil importing nations, especially emerging markets, are often the most vulnerable. Countries like India, Turkey, Pakistan, Thailand, Vietnam depend heavily on imported energy. When oil prices surge, their trade deficits widen, their currencies weaken, and inflation rises quickly. Analysts have already warned that the current oil shock could strain emerging markets far beyond just inflation, affecting currencies, capital flows, and economic stability. In other words, a disruption in one narrow waterway in the Persian Gulf can trigger economic stress across half the planet. Could oil really reach $120 or higher? Now let's address the big question. Could oil prices really move above $100 or even higher? The short answer is yes, and history shows it has happened many times before. During the 1970s oil crisis, prices quadrupled after Middle Eastern supply disruptions. In 2008, oil briefly surged to nearly $147 per barrel. And in 2022, the Ukraine war pushed prices above $120 per barrel. When supply shocks collide with geopolitical conflict, the results can be dramatic. The supply reality one reason oil markets are so sensitive today is that global supply growth has slowed significantly. Over the past decade, investment in new oil projects declined as energy companies focused on profitability and energy transition goals. That means spare production capacity is limited. So when disruptions occur, there's less cushion to absorb the shock. Now, here's a fascinating question. What happens if oil stays above $100 for an extended period? History suggests 3 things usually follow: higher inflation, slower economic growth, and increased geopolitical competition over energy resources, which brings us to the next piece of the puzzle. The geopolitical chessboard, the Strait of Hormuz crisis, is not just about oil, it's also about geopolitics. Major powers, including the United States, China, and European countries, all depend on energy shipments passing through this region. Asian economies, in particular, rely heavily on Middle Eastern oil. China, India, Japan, and South Korea account for the majority of imports traveling through the strait, which means any disruption could create enormous economic pressure across Asia. The energy security debate. Events like this often reignite debates about energy security. Countries begin asking difficult questions. Should we rely so heavily on imported energy? Should we accelerate renewable energy development? Should we increase domestic oil production? These debates shape energy policy for years after major oil shocks occur. What investors are watching. For investors, the oil market is sending several important signals. Energy stocks tend to rise when oil prices surge. Airline and transportation companies often struggle. Inflation-sensitive assets like gold sometimes benefit, and stock markets become more volatile overall. In other words, oil isn't just an energy story. It's a macro story. The bigger picture. Ultimately, the warning from Goldman Sachs highlights something bigger than just a short-term price forecast. It reminds us how fragile the global energy system can be. A single geopolitical crisis, a single shipping route disruption, a single regional conflict. And suddenly, the entire global economy feels the impact. The world depends heavily on stable energy supplies, and the Strait of Hormuz remains one of the most critical links in that system. If shipping flows recover quickly, oil prices may stabilize, but if tensions escalate and disruptions continue, the risk of oil prices surging above $100 per barrel becomes very real. And if that happens, the consequences could ripple across. Inflation, financial markets, economic growth, and global geopolitics. If you found this breakdown helpful, make sure to subscribe to the channel for more deep dives into gold, oil, commodities, and global macro trends. And now I want to hear from you. Do you think oil prices will stabilize soon? Or are we heading toward another major energy shock? Let me know your thoughts in the comments below. Thanks for watching. And I'll see you in the next video.